After studying this module, you shall be able to understand what is microfinance, to understand why we need microfinance, to know what are the various microfinance institutions, and growth in the microfinance sector. The notion of microfinance finds its genesis in the practice of money lenders who lent money to the poor and needy in the rural areas at very harsh rates and recovered it with equally harsh ways with a very steep rate of interest, which are known to our policymakers for time immemorial. Saving the rural poor from the clutches of these kinds of money lenders, the creation of regional rural banks or RRB in India since 1975 was ushered in by the government. Microfinance units offer small scale financial services in both the forms, credits and savings, especially to the poor in the rural, semi-urban and even in urban areas. These financial services help them in undertaking economic activities, minimizing their vulnerabilities to income shocks, increasing savings and supporting self-empowerment. There are a number of microfinance units which are highly fragmented with more than 3,000 microfinance companies or MGIs, NGOs and NGO MFIs. There is a high concentration of microfinance units in India with top 10 microfinance companies accounting for almost 74% of the total loans outstanding. The industry for micro lenders has grown phenomenally during the last few years, registering a quantum jump in loans given and the number of new MFIs coming into function. Such a huge growth clearly shows that Indian microfinance segment has started playing an important role for the financial inclusion. Microfinance sector has grown rapidly over the past few decades. Nobel laureate Muhammad Yunus has laid the foundation of the modern MFIs with the establishment of the Grameen Bank in Bangladesh in 1976. Today, it has become a very strong financial service industries with a variety of business models. Microfinance institutions, MFIs in India exist in different forms, one as NGOs, second as a Section 25 company or as non-bank financial companies or NBFCs. Commercial banks, regional rural banks and cooperative societies have also played a strong role in providing a backup finance known as refinance facilities to MFIs. Banks have also come up forward to refinance the self-help groups or SHGs channel to provide direct credit to group borrowers. Microfinance has taken a center stage as a reliable and promising channel for financial services to unbanked sections of the rural population. Financial inclusion is emerging as a major policy objective of India. However, some malpractices followed by certain lenders in Andhra Pradesh few years ago have subjected microfinance sector to greater scrutiny and need for stricter regulation. What is microfinance? Microfinance is the provision of financial services to low-income clients or solidarity lending groups, including consumers and the self-employed, who traditionally lack access to banking and related services. Microfinance should not be looked from the narrow perspective of just giving microcredit to the poor. Rather, it acts as a strong economic development tool to help the poor to come out of their poverty. It includes a wide range of services like credit, savings, insurance, remittance, and also non-financial services like training, counseling, etc. All these help a lot the poor segment of society. The salient features of microfinance are that borrowers are from the poor strata of the society or belong to a very low income group. Loans are small sized or micro loans. These loans are for a very short duration. There are no collaterals offered for these loans. The frequency of repayment is in small amounts is very high. Loans are generally taken for income generation purpose, that is, they are used for supporting some business or entrepreneurship. Why do we need microfinance? Most poor people find it extremely difficult to mobilize resources to develop their enterprises and their dwellings. Conventional sources of finance from banks and other institutions seldom lend to serve the needs of low-income families and women-headed households. They are often denied access to credit for any purpose. The lack of access to credit for the poor is primarily because of the practical difficulties arising from the mismatch between the way the banks and financial institutions operate. For example, commercial lenders require that borrowers have a stable source of income to pay back principal and interest according to the agreed terms and conditions of the loan. However, the income of many of the self-employed households is not stable. A large number of small loans are needed to serve the poor, but bankers and institutions prefer to deal with large-sized loans in smaller numbers to minimize their administration cost. They also look for some security or collateral with a clear title, which many low-income households do not have. In addition, bankers tend to consider low-income households a bad risk, imposing exceedingly high information monitoring costs on operation. This all creates a big gap in the demand and requirements of the low-income groups and the supply of funds from the banks and institutions to these group of needy borrowers. India inhabits almost 1/3 of the total world's poor. Microfinance plays a major contributor to financial inclusion by providing a source of finance to this segment of the society. In the past few decades, it has helped out remarkably in reducing the poverty in some of the areas of the society. Reports show that people who have taken microfinance have been able to increase their income and hence improve their living standard too. About 50% of Indian population still doesn't have a savings bank account and are therefore deprived of all banking services. Poor also need financial services to fulfill their consumption needs, housing, business, and risk management needs. Microfinance institutions serve as a supplement to banks. These institutions not only offer microcredit, but they also provide other financial services like insurance, remittance, savings, and non-financial services like individual counseling, training, and support to start new business. The borrower receives all these services very conveniently at his place of residence with the repayment schedule of borrower's convenience. This acts as a very strong factor for the growth of microfinance sector in India during the last few years. But the borrower has to pay a cost for all this in terms of high interest rates charged by some of these institutions. The interest rates vary widely from 10 to 30%, which is far higher than the rate charged by the commercial banks. Channels of microfinance. In India, microfinance operates through two channels: SHG, Bank Linkage Program, SBLP, and second, microfinance institutions. SHG, which is Bank Linkage Program. This is the bank-led microfinance channel which was initiated by NABARD in 1992. Under the SHG model, the members, usually women in villages, are encouraged to form groups of around 10 to 15. The members contribute their savings in the group periodically, and from these savings, small loans are provided to the members. In the latter period, these SHGs are provided with bank loans, generally for income generation purpose. The group's members meet periodically when the new savings come in. Recovery of past loans are made from the members, and also new loans are dispersed. This model has been very much successful in the past, and with time it is becoming more and more popular. The SHGs are self-sustaining, and once the group becomes stable, it starts working on its own with some support from NGOs and institutions like the NABARD and the SIDBI. Microfinance institutions. Those institutions which have microfinance as their main operation are known as microfinance institutions. A number of organizations offer microfinance services. These institutions lend through the concept of joint liability group, JLG. All the MFIs consisting of NBFCs, Section 25 companies and cooperative societies put together account for about 42% of the microfinance sector in terms of loan portfolio. NBFCs dominate this MFI segment with more than 80% of the portfolio. Although the microfinance sector is having a healthy growth rate, there have been a number of concerns related to the sector, like grey areas in regulation, transparent pricing, low financial literacy, etc. In addition to these concerns, there are a few emerging concerns like cluster formation, insufficient funds, multiple lending, and over-indebtedness, which are arising because of increasing competition among the MFIs. On a national level, there has been a spate of actions taken to strengthen the regulation of the MF sector, including enactment of microfinance regulation bill by the government of Andhra Pradesh, implementation of sector-specific regulation by the Reserve Bank of India, and most recently release of draft microfinance institution development and regulation bill 2011 for comments. How to improve the working of the microfinance industry? The first is proper regulation. There is a great need for an enabling regulatory environment that protects interest of stakeholders with microfinance sector growing to full stature with its completion of almost 2 decades of age with a high growth during the past few years. Supervision. There is great need for the strictest supervision by executing field visits for monitoring the conditions at the grassroots level and initiating corrective action whosoever demanded. This will keep a check on the performance of ground staff of various MFIs and their recovery practices. Encourage rural penetration. Most of the MFIs are opening their new branches in places where some MFIs are already operating. Encouraging MFIs for opening new branches in areas where microfinance penetration is meager shall increase the depth of the microfinance availability in the state and check multiple lending. Wide range of products. MFIs should provide complete range of product including credit, savings, remittance, financial advice, and also non-financial services like training and support to the needy in the rural and semi-urban areas. Transparent interest rate. Some of the MFIs are reportedly employing different patterns of charging interest rate, and some of them are also charging additional charges or insisting on interest-free deposits. All this makes the pricing very confusing and costly, and hence the borrower feels incompetent in terms of bargaining power. Uniform interest should be charged by all MFIs so that it makes the sector more competitive. Lower operating cost. MFIs should use new technology and IT tools to reduce their operating costs. These cost-cutting measures shall help in operating cost reduction, which in turn get translated into lower costs charged from the poor borrowers. Moreover, initiatives like development of common MIS and other software for all MFIs can help make the operation more transparent and efficient. Rating of MFIs. CRISIL has been associated with the Indian microfinance sector for more than a decade, and its rating and reports about MFIs and the sector are highly referred to by microfinance practitioners, analysis and general public. CRISIL has ratings or grading outstanding on more than 60 Indian MFIs, which account for more than 65% of the loans outstanding in the Indian microfinance sector. Andhra Pradesh problem in 2009 with microfinance companies facing crisis of confidence changed the status of industry in terms of rating. The microfinance sector turned turtle with many of the top MFIs from the 2009 list missing from the 2014 list of top ratings. Microfinance Institutional Network, MFIN, is the first self-regulatory organization, SRO, in the financial services segment recognized by the RBI. This regulates MFIs to ensure responsible lending and protection of the client. MFIN works closely with all key stakeholders and plays an active role for larger financial inclusion through the medium of microfinance. As a self-regulatory organization, MFIN members comply with the RBI's Fair Practices Code and Industry Code of Conduct to ensure responsible and transparent business practices. Latest development in microfinance. Private equity PE investors have put in substantial amounts in microfinance institution MFIs and NBFCs or non-bank financial companies over the years. Recently, with many of the MFIs have been permitted to become small finance bank or SFBs, PE investors are expanding their role to guide and help them during this transformation of SFBs. According to Reserve Bank of India norms, SFBs have to start operation by April 2017. The announcement to create a micro unit development refinance agency, Mudra Bank, is a strong positive step that the finance minister has taken on the microfinance and financial inclusion space, since this is a move aimed at providing refinancing for small business enterprises. It addresses a huge gap in the current refinancing structure. Prime Minister recently launched Mudra Bank under Pradhan Mantri Jan Dhan Yojana, which will provide credit of up to 10 lakhs of rupees to small entrepreneur and act as a regulator for microfinance institution MFIs. Mudra Bank aims to fund the unfunded small entrepreneurs need to strengthen savings habit in the country. Providing access to finance to micro units will help in improving the quality of life of these individuals, but also turn them into strong instruments of economic growth and employment generation in the country. Microfinance IPOs in 2016. With the revival of the industry during the last few years, many of microfinance units are planning to come out with public issues. A long list of initial public offerings of IPOs from microfinance companies is expected to hit the Indian market over the next 1 year. The first to hit the IPO market was Equitas Holding, which is one of the 10 companies that have been selected by the RBI to set up small finance banks, niche lenders aimed at helping small business and farmers get easy access to funding. Many more companies are lined up for public issues. Ujjivan Financial Services Limited is one of the microfinance companies coming up public issue soon. Summary. Despite initial fear and the hiccups of 2009 about microfinance as a strong source of finance to the rural poor to achieve the national objective of financial inclusion, microfinance has prospered during the past few years in India. The establishment of the Grameen Bank in Bangladesh and Mudra Bank in India has given a great fillip to microfinance. Many of the IPOs and the graduation of microfinance companies to small finance bank has changed the whole complexion of the microfinance in India. In case the progress continues at the same pace, the financial inclusion objective of the country can be achieved more efficiently and quickly.